Welcome from me, Guy Monson, to our regular 6-minute strategy. Despite the bluster, confusion and policy U-turns coming from President Trump's administration, MAGA policies are actually gaining traction on the ground, far sooner than many had guessed possible. In the charts ahead, we'll look at immigration across the main US borders, which has more or less entirely ceased, and also look at the growing revenue the US is already earning from tariffs. On trade deals, by contrast, the news is less good. At present, there is only one, an unsigned tariff agreement with the UK. To be fair, after US talks with China in London this week, there may be progress on a wider deal, or it may be just a policy framework. In short, uncertainty is still very high, while US business sentiment is weak. Against this challenging backdrop, global equities managed to reach a new high this week in US dollar terms, while dividend growth and share buybacks continue to look robust. In short, the equity market and the economy are sending out rather different messages. The former suggests that companies can live with MAGA policies and tariffs at today's rate of around 10 to 15%. The latter says future price rises and policy confusion are hurting business. We'll see who's right in the slides ahead. So let's begin by looking at the performance of global markets. In the left-hand panel, this is world equity indices. Now, I normally plot this in sterling, but I plotted it for a dollar investor today. And you can see that sharp decline following Trump's Liberation Day speech, and then this recovery actually taking markets above the level they were on that Liberation Day announcement. On the right-hand panel, you can see the continued decline in the dollar, down about 8 or 9% for a sterling investor, hence the difference in equity returns if you adjust. In the bottom panel, I've shown that oil prices continue to be weak in the face of 3 production increases by OPEC, led by Saudi Arabia. So where against all of this is the tariff agenda running? Well, in that bottom panel there, you can see average tariff rates as calculated by Morgan Stanley. Going into the election, Biden was running about a 2% tariff rate. Once the worst of Trump's announcements were combined together, we were running at 29%. We're around about 15% today. And that's probably a tolerable number, according to academics, of somewhere around 10 to 15% to deploy global tariffs without too much damage to the world economy. Where ultimately might they land? Well, I think for friendly nations, they'll follow the UK model and land somewhere around 10%. That's for UK, India, Australia, LATAM and Japan, South Korea, etc. For nations with larger budgets, with larger trade surpluses like the EU and China proxies, Vietnam, Cambodia, probably they'll settle at a 20% rate. And it's still a huge guess, but our assumption is somewhere around 30% for China. We've looked at tariffs. Where else are Trump's policies beginning to be felt in the real economy? Well, on the left-hand panel, we obviously look at the decision to seal US borders, and that has had remarkable effects. What we call nationwide encounters, this is where customs and border meet with illegal immigrants. The numbers have just collapsed, both nationally, across the southwest border in red, and the northern land border in green. Extraordinary in just a few months. On the right-hand panel, also the tariff agenda, although it's in its infancy, is already collecting real money. It's risen on a monthly basis from about $7.5 billion under the Biden administration, somewhere around $24 billion today. That makes $200 to $250 billion annually, already a powerful contributor to the budget, and you see why this is so key to Trump's underlying policies. Against all of this, equity markets appear to have been cheering, as we saw. Now, why is this? Well, first of all, global earnings numbers look pretty reasonable at 12.3% for the year going forward. Now, that's flattered a bit by a weak dollar, but those are good numbers, and there are no harsh revisions. At least they're not being picked up by analysts for the moment. In addition, dividend growth is strong. Now, that's distorted a little bit by some of the low yielders upping their payments. Microsoft is the biggest in this respect, so it's not high yielding stocks, but it's strong dividend growth. In addition, as I said at our last 6-minute, share buybacks continue to be robust. So what does the future hold? Well, first of all, on valuations of the key AI names, there's pretty good news. Those valuations continue to compress. If you look at Microsoft, Google, Amazon and Meta, the key platforms, we come down from PE ratios of nearly 2 times the market to that current number of about 1.2 times the market. So nothing like the valuation premium we've seen in other technology booms and busts. So I'm relatively happy there. Where we're a little bit more worried, though, is as bond yields rise and equity prices rise, the equity risk premium continues to fall. And that's the additional return that investors demand on an equity portfolio compared to a bond portfolio. And that's beginning to flash a red signal as those numbers are somewhere near that US technology peak back in the late 90s and early 2000s. So what's the outlook for bond yields if that's the key risk? Well, I'm afraid again these growing deficits are an increasing issue for governments around the world, but particularly the US. And you can see that we're just about to break through the post-war high in overall debt levels. We're running a 6.7% budget deficit at the moment. These numbers are extraordinary for an economy that's actually growing strongly. On top of that, we've got to put the one big, beautiful budget bill, estimated at $2.4 trillion over 10 years, which that alone will add around 7% to US total debt, according to CBO and the Yale Budget Lab. How are bond markets reacting? Well, yield curves are steepening around the world. That means yields are rising at the long end and falling at the shorter end. And that's showing how reluctant investors are to fund these governments going forward. So we remain with our position, a modest underweight in global equities despite these returns, a key buffer of cash and gold to intervene in markets if we see real opportunities coming out. But overall, a thematic portfolio that's conservative, but appropriate, I think, for the risks we see in global markets today. Well, you can get more detail on these quarterly numbers from our new presentation, Portfolio Perspectives, with Tom Santralala and Michael Jervis once a quarter. I highly recommend it. Well, I hope this is helpful. I hope it's shown you how Trump policy is playing out on the ground and what this means for record highs in the US equity market. Thank you.